All right, welcome back to the deep dive. Today we're going deep, really deep,
Yeah.
into how banks handle risk.
Yeah, risk management.
Risk management. We're talking enterprise risk management, ERM, in the banking sector.
Huge topics.
It is a huge topic. It's not just about, avoiding losses. ERM is about a bank's culture, its skills, its practices, all working together,
Integrated.
integrated, exactly.
Yeah.
To handle risks
Yeah.
and actually ultimately create value, make the bank stronger.
For sure.
Now, while those ERM principles, they're pretty much universal, right? Banking, it's got its own unique flavor. We're going to untangle that, look at those specific banking considerations.
Absolutely.
So for this deep dive, we're using Pritesh Biswas's work, his chapter, Embedding ERM in Banking.
Great source.
Yeah, it's a great place to start. We're going to cover a lot. We'll look at the core functions of banks, the key risks they face. We'll see how regulators categorize those risks, dive into those boundaries between, credit risk, market risk, liquidity, all that.
Yeah, all interconnected.
We can't forget the big one, Basel regulations. We'll break down Basel III, the three pillars, all that good stuff.
Framework, yeah.
We'll also look at how banks use those internal models to crunch the numbers. Talk about VAR, expected shortfall.
The tools they use.
Exactly, the tools. Then we'll tackle conduct risk, which is getting more and more attention these days, especially from the FCA in the UK.
Yeah, they're really focusing on that.
And finally, we'll wrap up by seeing what keeps bankers up at night. The biggest threats on the horizon, according to that Banking Banana Skin survey.
Always interesting to see what they say.
Always interesting, right? All right, let's dive in. I think one of the first things that really struck me, reading through this chapter, is that you can't talk about risk management in banking without first really understanding how banks actually work.
Yeah, it's foundational, isn't it?
It is. Their core functions, what they actually do day to day, that's what ultimately creates the risks they need to manage.
Absolutely. It's like the DNA of banking risk, right?
And it's not just, making loans and holding deposit. It's all the activities that go into that.
The whole ecosystem.
Exactly.
Right.
And how those activities interact with the wider financial system. So before we get into all the specific risk categories and models, I think it's helpful to kind of step back and just, acknowledge that banks operate within this unique ecosystem.
It sets the stage.
Right, it sets the stage. And that ecosystem has risks baked in.
Oh, yeah, for sure.
So, okay, let's talk about those risks. Like, how do we even start to make sense of all the different ways a bank can potentially lose money or run into trouble?
Well, luckily, regulators, they've done a lot of work to categorize these risks to try to, bring some order to the chaos.
Oh, yeah, they love their categories, don't they?
They do. But it helps. It gives us a framework, a common language to talk about these things.
And it makes it easier for banks to, report on those risks consistently.
Yeah.
Which is good for, transparency and all that.
Absolutely. So what are those categories then?
Well, the article focuses on a few main ones. Strategic risk is a big one. That's all those uncertainties that can impact a bank's long-term strategy and objectives.
Right.
Think, disruptive technologies.
Fintech. Yeah.
Exactly. New competitors, changes in customer behavior.
Regulatory changes.
Huge ones.
Regulatory changes, huge. Geopolitical risks. Anything that can, fundamentally shake things up.
Speak up the whole game.
Exactly. Then you've got credit risk, which most people are probably familiar with. That's the risk of losing money because a borrower can't or won't repay their loan.
The classic one.
Yeah, the classic. But it's not just about individual borrowers, right? It's about the overall creditworthiness of a bank's loan portfolio.
Yeah.
So concentrations in certain industries or geographies, that can amplify credit risk.
For sure.
Okay, then there's market risk.
Which is all about those external factors that can affect a bank's assets and liabilities.
Like movements in interest rates.
Interest rates, yeah. Foreign exchange rates, commodity prices, equity prices.
Volatility, the whole shebang. Exactly. And those changes can lead to, significant losses if a bank isn't careful.
Absolutely. And then we've got liquidity risk. And I think this one's really important to understand.
Oh, crucial, especially after, recent events.
Exactly. It's all about a bank having enough cash or assets they can easily turn into cash to meet their obligations when they come due, whether it's depositors wanting to withdraw their money or meeting those short-term funding needs.
It's about being able to pay your bills, essentially.
Exactly. And this can go wrong for a lot of reasons, right? It could be a bank-specific issue, like a sudden drop in their credit rating, which makes it harder for them to borrow money. Or it could be a broader market freeze, where nobody's lending and everyone's trying to hoard cash.
Like when a run on the bank happens.
Yeah, exactly. And then finally, we've got this big bucket called operational risk. And this is where things get really interesting.
It's the catch-all, isn't it?
It is. It covers losses stemming from, well, pretty much anything that can go wrong internally. So we're talking failures in a bank's processes, people making mistakes, systems breaking down, or even external events like natural disasters or cyber attacks.
It's the human element, the technology element, the unexpected events element, all rolled into one.
Right. And the article actually breaks this down even further into these really specific subcategories. So you got things like internal fraud, like an employee cooking the books, or external fraud, somebody hacking into a bank's systems. Then there's employment practices and workplace safety, which can lead to lawsuits and all that.
Yeah, legal risks are a big part of it.
Clients, products, and business practices, like mis-selling financial products or not complying with regulations. Physical asset damage, like a fire or flood destroying a bank's building. Business disruption and system failures. Oh, a major computer outage, that would fall under that.
That's a big one these days.
Yeah, absolutely. And then finally, there's execution, delivery, and process management, which covers things like, messed up payments or trades. So it's really a very broad category.
It's everything in the kitchen sink.
Yeah, it kind of is. But these categories, as helpful as they are, the lines between them, they can get pretty blurry in the real world.
Right. Oh, yeah, for sure. Risk management, it's not a siloed thing.
It's all interconnected, isn't it?
It is. And I think that's one of the key takeaways here, that you can't just manage these risks in isolation.
You need that holistic view.
You do.
Yeah.
A bank has to be thinking about how, a failure in one area could trigger problems somewhere else.
Exactly. And that requires, it requires a lot of coordination and communication across different parts of the bank.
Communication is key.
Communication is key, absolutely. The article gives some really interesting examples of how, one type of risk can actually be caused by another. So credit risk, for example, we tend to think of that as, the borrower's ability to repay. But what if the loan was made based on fraudulent information?
Ah, so it becomes operational.
Right. Or what if the bank's lending procedures weren't followed properly?
Or they didn't properly assess the collateral.
Exactly. So in those cases, what looks like credit risk actually has its roots in operational risk.
Absolutely. It's about understanding the root cause.
And the same goes for market risk. We tend to think of that as driven by those big market moves, interest rates, currencies, all that. But what if a trader makes a mistake?
A fat finger trade.
A fat finger trade, yeah. Or what if a bank's systems have a glitch and they accidentally exceed their trading limits?
Or there's fraud even, rogue trading, that kind of thing.
Right. So again, what seems like pure market risk actually has an operational component.
And it's not just those two. Even liquidity risk, which you'd think is all about, market conditions and access to funding, that can be influenced by operational factors too.
In what ways?
Well, think about it. If a bank's models for forecasting their future cash flows are wrong...
Because of bad data or bad assumptions.
Exactly. Or if their investment strategy is mismatched, like they're relying too much on short-term funding, or if their systems for processing payments have delays or errors...
So internal problems can lead to a liquidity crisis.
They absolutely can. It's all connected.
And it even goes beyond those core financial risks. Insurance risk for banks that offer insurance products that can become operational if, say, they're not following their underwriting guidelines properly, or if their actuarial models, the ones they use to price risk, have errors.
Or even just poor documentation.
Right. And even strategic risk, which is all about those big picture decisions, that can have operational roots too.
How so?
Well, think about it. If a bank makes a bad acquisition, maybe they didn't do their due diligence properly. Or if they pursue a strategy that's not aligned with their capabilities, because they didn't assess their internal resources effectively.
So poor decision-making, lack of oversight.
Exactly. Those are operational failings that can lead to strategic mistakes.
It really shows how important it is for everyone in the bank to be on the same page when it comes to risk management.
Oh, absolutely. It's a team effort. And that's where, having a strong risk culture is so important.
It's not just about ticking boxes. It's about everyone understanding their role in managing risk.
Exactly. And that culture needs to be embedded from the top down.
Leadership sets the tone.
Leadership sets the tone. Absolutely. So we've talked about the different types of risk that banks face. But all of this is happening within a pretty heavily regulated environment.
Oh, yeah. Banking is one of the most heavily regulated industries out there.
For good reason, right? Because when banks fail, the consequences can be catastrophic, not just for their shareholders, but for the entire financial system.
Systemic risk.
Systemic risk, exactly. So the primary goal of bank regulation is to ensure that banks have enough of a cushion, enough capital to absorb losses and keep operating even when things go wrong.
It's about protecting the stability of the system as a whole.
Exactly. And the Basel framework, that's the global standard for bank regulation. And it's been evolving for decades.
It's had to keep up with all the changes in the industry.
Right. So we've got Basel I, Basel II, and now Basel III, which is the current framework. And they've all built upon each other, adding more rules, more sophistication, trying to stay ahead of the curve.
It's a constantly moving target.
It is. And the Basel Committee on Banking Supervision, they're the ones who develop these rules. They're an international body made up of regulators from all over the world. And their website, if you're interested in this stuff, www.bbasel.org, it's got all the latest updates.
It's a good read.
So the Basel framework, it's built around these three pillars. Pillar 1 focuses on capital requirements, which is basically how much capital a bank needs to hold based on the riskiness of its assets.
Risk-weighted asset.
Risk-weighted assets, exactly. So different types of assets are assigned different risk weights. Like a loan to a very creditworthy borrower might have a low risk weight, while a loan to a riskier borrower would have a higher one.
Makes sense.
Yeah, so the riskier the bank's overall portfolio, the more capital they need to hold.
It's a way of making sure they have enough of a buffer.
Exactly. And Pillar 1 covers those main risk categories we talked about: credit risk, market risk, operational risk. And it outlines all the acceptable methods for banks to calculate those risk weights and what qualifies as capital.
So it's the quantitative side of things.
Right. Then Pillar 2 is the supervisory review process. So this is where things get a bit more qualitative.
It's about judgment, expertise.
Exactly. So banks are required to conduct their own internal capital adequacy assessment process. That's IIAP. It's basically their own internal assessment of how much capital they need based on their specific risk profile.
So it's not just about following a formula.
No, it's about really understanding your risks, your business model, your risk appetite.
And regulators and review those assessments.
They do. And they can challenge them if they think the bank's being too optimistic or if their risk management practices aren't up to snuff.
It's a check and balance.
It is. And then Pillar 3 is all about transparency and disclosure.
Making sure the information is out there.
Right. So banks are required to publicly disclose information about their risk management framework, the types of risks they're exposed to, and their capital adequacy.
So investors and the public can see what's going on.
Exactly. And this typically takes the form of like an annual report, the Pillar 3 disclosure report. So it's about giving stakeholders a clear picture of the bank's risk profile.
And holding them accountable in a way.
Exactly. So those are the three pillars. And beyond that, Basel also sets out some key principles for how supervisors should, oversee banks. So there's the capital adequacy assessment, where banks need to proactively evaluate their capital needs based on the risk profile. Then there's regulatory oversight, with supervisors monitoring those assessments and making sure banks are meeting the minimum requirements.
Making sure they're playing by the rules.
Right. And then there's this idea of capital buffer expectations. It's basically regulators saying, look, we want you to hold even more capital than the bare minimum just to be safe.
A bit of extra cushion.
A bit of extra cushion, yeah. And finally, there's early intervention. So if a bank is starting to look shaky, supervisors need to step in and take corrective action before things get really bad.
Preventative measures.
Exactly. Now, the Basel framework, it's a global standard, but each country implements it in their own way.
They adapt it to their own context.
Right. So in the UK, for example, we've got the FCA and the PRA. Those are the main regulators overseeing banks.
Yeah.
And they've incorporated Basel into their own rules and regulations.
They're the enforcers.
They are. And what the big challenges they're facing now, and this is something the article highlights, is the rapid evolution of the banking sector.
Things are changing so fast.
They are. We've got cryptocurrencies, digital banks, all these new technologies and business models. And they're introducing new risks, new complexities. So regulators are constantly trying to keep up, trying to adapt the rules to this changing landscape.
It's a game of cat and mouse.
It is. It really is. So another important aspect of risk management in banking, and this is something we touched on earlier, is the use of internal models.
So going beyond those standardized formulas.
Right. So instead of just relying on those risk weights set by regulators, banks can develop their own models to calculate their risk capital needs. And these models, they can be very sophisticated, using all sorts of data and algorithms to try to capture the bank's unique risk profile.
It's about getting a more granular, more accurate picture.
Exactly. But there are some key principles that govern the use of these internal models. First of all, senior management. They need to really understand how these models work. It can't just be a black box.
They need to be able to explain it to the regulators.
They do. And they need to be confident that the model is actually aligned with the bank's overall risk management framework. It's business strategy.
It has to be integrated into the decision-making process.
Exactly. And the model needs to be used for more than just calculating capital. It should be a tool that informs risk management decisions across the board, covering a wide range of risks.
Not just a compliance exercise.
Right. And ultimately, the goal is to have a model that actually improves the bank's risk management capabilities.
Makes them more resilient.
It makes them more resilient, absolutely. And one of the most well-known internal models, especially for market risk, is value at risk, or VAR.
The classic market risk measure.
It is. So VAR, it basically tries to estimate the potential loss in a bank's portfolio over a certain time period, given a certain confidence level.
So you might say there's a 99% chance that our losses won't exceed X amount over the next day.
Right. So it's a probabilistic measure. But it has some limitations.
Yeah.
And the article, it really stresses this.
It's not a crystal ball.
It's not. So VAR, it doesn't tell you the absolute worst case scenario. It tells you the likely loss, but there's always a chance, however small, that the actual loss will be much bigger.
And those tail events, they can be really nasty.
They can. And we saw that in the 2008 financial crisis. Some banks, their losses were way beyond their VAR estimates.
Multiple times bigger.
Multiple times bigger. So VAR, it's a useful tool, but you have to understand its limitations.
It's not the be-all and end-all.
And that's why regulators have been pushing for banks to also use expected shortfall, or ES, which tries to capture those tail risks.
It looks at the average loss beyond that VAR threshold.
Right. So it's still not a maximum loss figure, but it gives you a better idea of what could happen in those extreme scenarios.
It's a more conservative measure.
It is. So we've talked about a lot of quantitative risk measures, but there's also this whole other side of risk management that's become increasingly important in recent years. Conduct risk.
The human side of risk.
The human side of risk, exactly. So conduct risk is all about ensuring fair outcomes for customers and maintaining the integrity of the financial markets. So it's about preventing things like mis-selling, market manipulation, insider trading, all those things that can erode trust in the financial system.
It's about ethics, really.
It is. And the 2008 financial crisis, it really highlighted the importance of conduct risk because a lot of the problems stem from, well, let's just say, questionable behavior.
Greedy behavior.
Greedy behavior, exactly. So since then, regulators have been cracking down, trying to make sure that banks have strong conduct risk frameworks in place.
Frameworks for doing the right thing.
Right. And the FCA in the UK, they've been particularly active in this area. They actually require firms to detail their conduct risk frameworks in their regulatory business plans, showing how they're going to identify and manage these risks.
It's a key focus for them.
It is. And they're looking at several things. How a firm defines conduct risk, what tools they use to detect it, what role the frontline business units play, and how they make sure that conduct risk identification is consistent across all parts of the organization.
Joined up thinking.
Joined up thinking, exactly. And they've also implemented specific conduct rules for individuals working in banks, as well as separate rules for senior managers.
To hold individuals accountable.
Exactly. So for individuals, the rules are pretty straightforward. Act with integrity, exercise due skill, care, and diligence. Be open and cooperative with regulators. You know, the basic.
The ethical foundation.
Right. But for senior managers, the expectations are even higher. They need to make sure their areas are effectively controlled, that they're complying with all the regulations, that they're delegating properly, and that they're being transparent with regulators. They have a lot of responsibility.
The buck stops with them.
It does. So finally, let's talk about that Banking Banana Skins survey. It's always interesting to see what bankers themselves see as the biggest risks on the horizon.
It gives you a glimpse into their worries.
It does. And in the 2021 survey, the top risk was crime, which had actually risen from second place in the 2015 survey.
So crime's on the rise.
It seems so. The macroeconomic environment, that was the top concern in 2015, but it dropped to second place in 2021.
Maybe they felt a bit more optimistic about the economy?
Maybe. Technology risk, that stayed pretty high, moving up to third from fourth.
Cybersecurity, all that?
Cybersecurity, yeah, it's a big one. And security risk, that was a new entrant in the top 10, which really highlights the growing importance of, protecting data and systems.
It's a whole new battlefield.
It is. And credit risk, that also moved up the list, as did quality of risk management and concerns about the business model.
So they're worried about their own ability to manage risk effectively.
Yeah, seems so. Business practices and reputation, those stayed in the top 10. But sustainability, That saw a big jump, reflecting the growing focus on ESG factors, environmental, social, and governance.
Investors are really pushing that agenda.
They are. And further down the list, there were some other interesting changes. Concerns about culture, compliance risk, international trade, all signs that the risk landscape is constantly evolving.
Always something new to worry about.
Always something new to worry about, yeah. So that's a whirlwind tour of ERM in banking.
A lot to cover.
It is. But I think the key takeaways are, first of all, the interconnectedness of these risks. You can't manage them in isolation. Second, the importance of having a strong risk culture that's embedded throughout the organization.
Top to bottom, yeah.
Top to bottom, yeah. And third, the critical role of regulation in ensuring the stability of the banking system. And that regulation is constantly evolving, trying to keep pace with all the changes in the industry.
It's a never-ending process.
It is. And that's why it's so important for banks to have robust risk management frameworks in place. Frameworks that can adapt to whatever challenges come their way.
Be prepared for the unexpected.
Exactly. Well, that's it for this deep dive into ERM and banking. A huge thank you to you, our listeners, for joining us on this journey.
We appreciate your time.
We do. And we hope you found it, well, insightful, informative, and maybe even a little bit entertaining.
A little bit, yeah.
A little bit. Until next time, happy risk managing.
Happy risk managing.
Thanks for tuning in to The Deep Dive.